Welcome to our virtual Lunch with City Leaders. I am Suzette Mahoney, most recently a partner at R2L Restaurant and the president of CCPA. So on behalf of CCPA, I would like to extend our heartfelt wishes that everyone is healthy and that you have the support that you need to endure this trying time. We are all navigating this unknown territory. We want to assure you that we are going to be with you every step of the way as we figure out how to help Philadelphia's business community overcome the challenges that lie ahead. We will continue to shift our programming and networking offerings to best support our members and guests, and we really would like to hear from you. So we welcome all suggestions. Please share your ideas in the chat feature throughout our program today. To talk about a few details about today's event, we are recording this so we can share it afterwards. You are encouraged to use the chat feature to ask questions, which we will answer at the end. Feel free to comment, make suggestions, and connect with each other. We mute everyone to maintain audio and visual controls, but we may invite you to unmute at certain times. And just as a reminder, you are live on video, so if you need to take care of business, feel free to turn off your video. CCPA is an intimate and diverse group of business owners, executives, and managers looking to build relationships and offer each other meaningful resources. That hasn't changed. We will continue to bring you unparalleled access to speakers, decision makers, and leaders who are shaping Center City. We will also continue to keep our members and guests informed about business challenges and opportunities in Philadelphia and help them become Center City smart. To touch on a few upcoming events, these will continue to be all virtual. This is our last Lunch with City Leaders for the summer, hard to believe. If you have ideas of people you would like to hear from in the future, please put them in the chat. Our next event is the State of Hospitality about the hotel industry on August 4th. And in September, we will feature the State of Meetings and Conventions. You can find a full schedule of our events on centercityproprietors.org. I'd like to acknowledge our sustaining sponsors, our preferred benefits provider, Michael Craig of Penworth Financial Services, and WeWork, which is the home of our headquarters. Lunch with City Leaders is made possible by Citizens Bank and our sponsors, Community College of Philadelphia, Friedman LLP, KYW News Radio, Post Brothers, and Visit Philadelphia. And now I'd like to welcome Lev Lane, President and CEO, and CCPA Vice President David Lane to say a few words and introduce our speaker.
Thank you, Suzette. Nice to be here and nice to see you all this afternoon. Lev Lane is a sponsor of Lunch with City Leaders. We're into our third or fourth year. We love doing it. And as many of you might know, Lev Lane is a integrated marketing communications organization headquartered in the Wanamaker building right across from City Hall. Branding, creative, media, online, offline, web development, strategy, so forth and so on for a great group of clients: financial services, healthcare, retail, franchise, education, life sciences, municipal, and so forth and so on. So we're happy to be sponsors and continuing support of CCPA. Now I'd like to introduce Lauren Gilchrist, and this will be an interesting presentation, folks, because Lauren is very much involved in commercial real estate, and many of us have offices that are managed by commercial real estate properties, and there's a lot of talk about when we get to the other side of this thing, because many of us are from what's the state of that industry? Do we need all this space? Can we do a hybrid? So maybe Lauren is going to address some of those things about what she sees as the state of that commercial real estate industry. She is a senior vice president, senior research at JLL in Philadelphia, where she directs local market research, their whole market research platform for the region. And her specialties include urban and regional economics and demography. Lauren previously served as the Manager of Research and Analysis at the Center City District in Philadelphia, a living, I would add, and also as a research analyst, program manager at the Center for Regional Economic Competitiveness in Arlington, Virginia. Lauren is also the president of the Greater Philadelphia chapter of the NAIOP, a commercial real estate developers association, and a member of the board of directors of our world-class orchestra. Her full biography is in the program that was sent to you earlier, so please join me by waving a warm virtual welcome to Lauren Gilchrist. Welcome, Lauren.
Thank you, David, and thanks everybody for the wave. It's so nice to see your faces, and it's so nice to be seen. When Ben first asked me if I would do lunch with you all today, it was just such an honor, to even be considered among the group of people that typically do this program. So thank you so much for having me. It's a real pleasure to be here. I'm going to today share my screen with you, to have a little bit of a context for the discussion. I hope you'll all have questions, as we kind of go through the program. And, I know we received instructions to kind of raise your hand or chat, those questions, but, please know that if you wanted to go rogue and unmute yourself and pop in with a question, it doesn't bother me. I was kind of hoping we would be in person at like a great restaurant, doing like the unplugged version of this, but nonetheless, we'll do our best to adapt here in the Zoom environment. So with that being said, we don't have to keep it super formal for my purposes whatsoever. I'd be happy to, have you pop in or comment or ask questions, as long as we can, be cognizant of the fact that we've got 40 people and I can't see all of you. Now I can just see 5 of you. So with that in mind, I really wanted to start today's discussion with an overview of our house view, and to talk to you a little bit about what we've seen happening over the last couple of months in the real estate market, specifically on the commercial side, with regard to the way that the dramatic changes in the country and in our health environment have begun to impact commercial real estate. So JLL in March 13th was the last day that I was at my desk in 1650 Arch. And we had someone return from Europe, and, he had been to Portugal, this person, and we were all like making a big joke about it because he had just like showed up at the office and put a sign on a conference room door that said quarantine room, and everybody laughed and like walked around and like, thought this was just so funny, only to sort of have, us be kind of kicked out by our leadership, by 3 o'clock that afternoon due to potential exposure, not to go back again. So I know I personally have probably about 4 dead plants sitting at my desk right now. I'm hoping for my succulent cactus to have made it, but it's been a massive disruption when we look across the market with regard to the ways in which we have all changed as a society, as a business community, and as a real estate community. So I share that kind of first anecdote, to jump into a couple of these slides where I'll try to give you a sense of where we see the world. But the thing I wanted to say before I kind of do that is anybody who tells you they know what's going to happen or that they have very firm predictions, I call BS on, simply because the data are so challenging right now due to not just sort of the erratic nature, not just sort of due to what I'll call a lack of leadership around the United States, but because no other economic cycle has ever kind of been teed up this way when it comes to the way in which we are entering this type of recession. So the abruptness of the halt that's probably killed my plants, we've never seen that before. It's producing unusual data in the economic forecast. And when economists forecast, they use past trends to predict future results. They use past data to look at, with some interval of confidence where we think we're going to end up. And the fact of the matter is that we've kind of blown all of these models out of the water with the abruptness of the shutdown. So questionable forecasting, really remains a hallmark of this particular cycle. I was on the phone with a client this morning who is in New York City, and we were talking a little bit about the environment there. And, every call starts with, well, how are you doing? Which feels a little bit strange in this environment. But, we were talking about how, one day, we wake up very optimistic. There's all these great headlines about vaccines. There's all of this positive, kind of scientific news coming out, life sciences demand in the real estate market, it's going to be great. And then the next day we kind of wake up and we look at the number of new cases, the number of new deaths, the kind of political spiraling, that's happening, the crazy kind of extra governmental activities. So this morning, watching an Instagram video, for example, of an unmarked van taking protesters with men in orange shirts wearing signs that said warrant patrol, right? Similar to what's happening in Portland. So that series of events is kind of expanding, right? And it feels very disconcerting because nothing feels like it's quite the same, and nothing is looking like what we would have expected. This is all coupled against a backdrop of a whatever it takes Fed policy. The Federal Reserve is using all of the tools in its tool chest right now to be able to correct the economy. And the question really among economists is, despite the massive amount of spending, despite interest rates falling next to zero, if you haven't refied your house, now's probably the time. Is it enough? Are we doing enough? Can we spend our way out of this problem? I did a calculation early in the pandemic, call it 6 to 8 weeks in, when the death rate was about 50,000 people. And at that time, we had spent about $3 trillion in federal stimulus. So not business losses, not sort of direct to consumer costs, not job losses, not salary losses, but direct fiscal stimulus of $3 trillion. And when we cut that check, against the, future livelihoods of our children and grandchildren, we had spent about $113 million per person that had passed away. And just to give you context for that, policymakers would put the value in calculations, and we can debate this philosophically, and you can tell me it's not the right number, and we can say that the value of life is limitless. But policymakers, when they implement things like the Clean Air Act or the Clean Water Act, would value, for modeling purposes, a human life at about a cost of $1 million. So even if you think it's worth 10 times that much, you can see, the difference between what we've spent at 113 million for the people that had died to try to correct the issue versus kind of what we would traditionally do in a robust policy analysis. So we spent a hell of a lot of money at this point, and we expect additional stimulus to come down the pike. I touched briefly on the health outcomes. I'm no biologist. I'm no scientist, I'm no doctor. The pandemic will dictate the economic cycle. I get very excited when I read the headlines, about vaccine trials and thinking about the Moderna trial and the fact that they believe that they can have a candidate in the fall subsequent to a 30,000 person test that they're recruiting for right now. And that's very exciting. And then, you think about like all of the other kind of concerns that we would have around efficacy, around dosing, around just cost. So it becomes very scary, but the pandemic will kind of dictate when we can recover. So I think that's important to keep in mind. So I'll jump into some data here just briefly so that we can kind of get a sense of what we are seeing in the market today from an economic perspective and then from a real estate perspective. So I mentioned that this cycle is unlike every single other cycle, and I think that this chart illustrates that maybe perhaps better than any other kind of chart that we have put together at JLL. So this chart's looking at the past 4 recessions in the context of the COVID-19 outbreak. And we all remember the pain of the 2008 recession and how deep and how long it felt like that lasted, where we saw an employment change from the previous peak to the tune of almost 6%. And that was over the course of almost 2 years before we hit the trough. COVID-19 is massively different in the sense that we saw employment changes of over 14% in a period of 2 to 3 months. It's also very different in the sense that we have already seen that massively rebound. to the tune of the fact that we're now only about 10% below the previous employment peak. So the question is, will that still go back up? Will sort of the resurging cases in other parts of the country impact these numbers? No one really knows. I would also just throw in that the election cycle is going to play a big role in a lot of what we're seeing in the data. Regardless of your political leanings, uncertainty is not the economy's friend. And the economy would perform much better if it felt like it knew which direction we were going from a political perspective. And there's quite a lot up in the air at this stage, which would have been the case no matter whether or not we had had the pandemic. Let's look at the unemployment rate here overall. The unemployment rate fell to 11.1% in June, which is still 10% above the unemployment rate high that we saw in 2010 in the last cycle. So to be sure, we're still above that peak, but we have definitely begun to kind of go back down from that peak. So, you know, economists would put full employment, which is about where we were at somewhere around 5%, which is where, you know, you start to get rising wages for workers because the supply of workers is far lower than the demand for workers. So wages start to rise. Certainly we've kind of bounded up from that at this point in time, but we still are significantly above where we were in 2010. I wanted to talk through this chart just briefly kind of with this group because you know, a lot of the unemployment that we've seen has been due to temporary layoffs. I know we have some leisure and hospitality folks here on the phone. I'm going to try to just kind of move some things around on my screen because I'm having a hard time seeing my own charts here. That's better. So most of the rebound that we've seen so far has come from the leisure and hospitality sector, so 59% of all employment. And that's largely due to the fact that we've seen restaurants reopen in some capacity, we've seen hotels reopen in some capacity, and we've also started to see some retail, you know, expanding its opening capacity. Outdoor dining is still the only way to eat out in Philadelphia beyond takeout, but to be sure, other markets, you know, are contributing to this significantly. So the fact that these two sectors, which have been so hard hit, are leading the recovery at this point in time, I think is indicative of the temporary nature of those layoffs and the fact that these businesses, you know, from a cash basis, just don't have excessive cash reserves. But when they can reopen, they do hire back because they do need that labor to function. Just briefly on retail sales, you know, I heard the term early in the pandemic of revenge retail. And this was essentially kind of getting at the concept of Americans really like to shop. And when you tell Americans you can't shop, they get very upset about this. So therefore, when they do get the opportunity to go spend money and go shop, which is what contributes to effectively our negative savings rate as a society, they will go back. So I spent part of the pandemic in Pittsburgh specifically, which opened up a little bit sooner than Philadelphia has been opening up. And what was interesting was to note that as soon as the Ross Dress for Less opened, the line was down the block to be able to go buy, you know, your pictures, your clothing, your tchotchkes, the whole thing. And I was just kind of like, I don't know that I would be comfortable with this right now in terms of the health concerns, but people really needed to get that decor. And that is starting to show up in the numbers here as well. So when we look at the retail sales seasonally adjusted, you can begin to see, you know, that we are almost back to where we were kind of prior to the pandemic overall. Certainly a shift to online shopping, certainly a shift to, you know, kind of online groceries, certainly changes in the environment, which we can talk a little bit about. But from a pure sales perspective, consumers are kind of showing that buying power, that revenge retail desire, and kind of behaving accordingly. And then let's just talk about unemployment for a moment by metro area, for example. So this particular chart looks at where we in Philadelphia rank. I mentioned the national unemployment rate is about 11.1%. Philadelphia is around 14.5% at this point. So still about 300 basis points above the national average. Which is not surprising to me, actually. Philadelphia has had varying levels of performance in the past two recessions. Sometimes we perform better than the national economy when it comes to unemployment, and sometimes we perform more poorly than the national economy when it comes to unemployment. And I would maintain that this is largely a function of our diversified economy. So we don't tend to kind of have high highs or low lows. It also has a lot to do with the fact that as America's fifth largest city, we have the highest poverty rate on the East Coast, somewhere around 26%. And even in the best of times, call it 6-9 months ago, we still were higher in terms of unemployment as a region due to some of the structural unemployment that exists as a function of the economy. So, this chart does not surprise me. And candidly, the fact that we rely so heavily on leisure and hospitality and tourism as economic drivers in the city specifically, this could have been far worse for the city overall. So we talked a lot about the worst case scenarios. We talked a lot about the data. We've talked a little bit about, kind of retail sales rebounding. So the question becomes, when is this all going to end? And I mentioned, anybody who tells you that they have a crystal ball and they can predict this is not worth their salt, but we kind of have to try to develop some sense of, when we can guide people to make real estate decisions. So this chart is looking at the various scenarios that we've projected. Somebody who has a PhD in economics, i.e. not myself, at our firm, that's trying to understand a little bit about like, what are we really in for? In the models, and what are the data telling us, as much as it possibly can. So this chart is looking at gross domestic product. So this is the value of all goods and services produced in the United States economy. And the line at the top is looking at where we were prior to the pandemic in terms of total gross domestic product. And so obviously you can see the downward spiral of the pandemic, but we're looking specifically at 3 scenarios here. The red line is kind of the base case scenario of when we feel we will most likely be to that pre-recessionary GDP level, and we are benchmarking that at approximately Q1 of 2022. So we're in this for 18 months probably, but that would not be, as long as the Great Recession lasted in the 08-09 crisis. So that's some good news. The upside case is that we could be back to some level of economic normalcy by Q3 of 2021. I think a lot of this, to the first slide I was saying about the health crisis dictating the cycle, if we can get a vaccine, if it proves effective, if we can dose it correctly, if we can distribute it effectively, the distribution actually seems far more challenging at this moment than the actual kind of science. We believe that we could be back at that pre-recessionary level by Q3 of 2021. And then worst case scenario could be 2023 or 2024 before we are back to that level of GDP. I don't like to think about that, but in a real estate driven business, for example, a 2023 kind of acquisition date, disposition date, lease signing date, these are not too far in the future. So our business has an extended cycle to it. So for us, this isn't as scary as I think it is for a lot of other business owners. One of the questions that I get a lot about this cycle is about the national debt. So one of the concerns and questions that kind of emerges is can the United States spend its way out of this problem? Can we continue to take on debt at this rate? And this chart is specifically looking at debt to GDP, again, so gross domestic product versus the amount of debt that the United States is in. And it's looking at that ratio. So currently we are around 120% debt to GDP, meaning we are borrowing more than we are producing as a society. Philosophically, that's kind of a problem, right? But nonetheless, we've been running at this excessive rate for quite some time. The problems start to arise based on what macroeconomists say around 250% debt to GDP ratio. So we are not doing great, but we are not sort of near those critical levels. And just to put it into context for, kind of where other countries stand on this spectrum, Japan is nearing that spot, that 238% of a ratio of debt to GDP. Italy is exceeding us, but we are really 107% or so debt to GDP at this stage. So not raising the alarm bells just yet. I still kind of philosophically get concerned, but the smarter people in the room think that we're doing okay. I apologize that some of these numbers are overlapping here on this chart, but one of the questions that we get frequently as people who predominantly deal in office space is what's going to go on with return to work? Do people want to work from home? Are we ever going back to the office? Am I ever going to water my plants again? And the fact of the matter is that most people, while we've proven that this can work, I think everybody on this call would agree that like something is very much lost about the fact that you all aren't eating your lunch and I'm not, standing at a podium and you have to unmute or you have to chat Ben to be able to ask a question or interact, right? And so we're doing okay. We're making it work. Like we're getting through it, hopefully again, optimistic scenario, Q3 2021, we're like back full steam as an economy, fall, like maybe we can all like do this if we all get a vaccine. But, what happens to what's lost, right? And what we've heard from our clients time and again is the fact that people are getting it done, but innovation is not happening. People are getting it done, but new ideas aren't being generated. People are getting it done, but especially if we, have kids staying at home, all fall at this stage, it's going to be difficult to get it done. And it's definitely going to be difficult to get creative. So our survey data and Gensler survey data is what we're looking at here. JLL occupancy survey on the right, Gensler survey data on the left. Gensler has found in who they've surveyed that 70% of people want to spend the majority of their time in the office. Only about 12% of people want to spend their entire day full-time and remote. And somewhere in between, that kind of 26% mostly in the office, 18% 3 to 4 days at home, is a bit more of a flexible strategy. So when we surveyed our landlord clients and our tenant clients, we found that 51% of companies are going to expand their work from home policies. So JLL, we've always had like a flexible policy. Like I walked out of the office on March 13th and I had a laptop and I had a cell phone the company pays for, and I had a VPN, and like we were basically ready to rock and roll because real estate's a remote business in some sense. We can really work from everywhere most of the time. We'd prefer to be together. We like to be together, but we've always had that redundancy because I would travel 6 or 7 times a year, right? And some days I just want heads down work to happen at home. But not every company is as fortunate as we are. So 51% anticipate expanding on the work from home policy. However, 94% of everybody's employees want to have the option of returning to the office. So that's largely been influenced by the amount of people that take public transportation. 29% of people who previously commuted via public transit want some type of alternate way to get to work. I'm concerned about traffic if we get up to full steam and full working, at home or working at the office. So we're going to have to work through that. And I think SEPTA's got a big challenge ahead of us. I'll just talk briefly here for a bit about the office environment and kind of what we're seeing in terms of office leverage. So this chart is looking at leasing activity around the United States. We saw a 21% drop in deals signed around the US in Q1. We saw a 53% drop in Q2. So for a company like ours that's predominantly dependent on brokerage revenue, this is obviously concerning. What we did see most people do was shift from, considering a new lease deal to renewing in place on a short-term basis. So our brokers are fairly busy actually right now, kind of executing on 12 to 24 month short-term renewals because companies are like, I can't take on the expense of building out new space. I don't want to move. I don't know how much space I actually need. Let's wait till this thing settles down. However, there are some growth-oriented companies around the United States. A couple of them are listed here that continue to sign large leasing deals. We've never been a large lease market in Philadelphia. So, these would be like the mega deal of the century if we saw a 500,000 square foot lease to Microsoft, but nonetheless, that is not our market. So the takeaway is really just that most people are renewing. We shifted from 30% renewal to 50. So I'll talk just briefly about a couple of other asset classes here with regard to emerging trends. JLL does track all asset classes to some degree, but our expertise is mostly office. So I'm just going to share a few high level things that we're seeing in other asset classes. So on the hotel front, I think we probably have some folks whose businesses are dependent on the hotel environment here. We have seen a shift to domestic drive-to locations for recreation, vacation that are less dense. Previously we've been seeing a lot of people traveling to cities. Cities have been, really in vogue for travel destinations. Recently, people really aren't doing that anymore. There's been a call for flexibility from labor unions and hotel management companies in order to be able to keep hotels profitable. So it's a heavily unionized environment. Obviously the unions are having to adjust and management is going to have to adjust as well. Clean is kind of the ongoing kind of word that they're hearing in our hotel segment the most. It's become an amenity. It's become a marketing tool. So companies have shifted significantly to implementing those procedures. We're going to see an increase in the number of distressed hotel assets, especially in the gateway cities where travel, just isn't happening because it's a city and people aren't traveling to dense cities. And hotels are also becoming more creative in attracting demand. I mean, my favorite commercial on TV right now is the hotels.com commercial. If anybody has seen this, like, I'm watching more TV than ever before. I can't even believe that I'm admitting this to you all, but it's like the guy in like the general's hat, and he was like, this place is so placey, and it has air that you haven't breathed before, and it's got free toilet paper. Like, we're still here, but OPS, like, you can cancel anytime up until like 48 hours of your trip. So I think that's kind of where we're evolving to, is a lot more flexibility on travel in order to entice consumers back out of their homes. So this chart is looking also at what is kind of happening in the market overall with regard to hotel performance. So as you can see, we've seen significant drop-offs across all of the markets, not a surprise. With supply growth, kind of contracting as companies have shut down. So, we probably have added, or about to finish a cycle where we're adding 2,000 hotel rooms to the Philadelphia market. I would anticipate that not all of those projects will complete. You can certainly start to see, that happening as shutdowns happen across some of the major tourist markets. And, also when we get into revenue per available room, you begin to understand just how fast, the hotel segment has contracted. RevPAR in Philadelphia is down by about 50% at this point in time in the year. So I'll touch briefly on multifamily. I think I'm getting a little closer to the end of my comments here. So if we're getting ready, for some questions, that would be awesome. Get those in your back pocket so that I can take a breather and a drink of water, and hopefully we can have a nice chat. But a couple more data points. Declining multifamily rent relief requests. This is good. Across some of the Class A landlords that I interact with in Philadelphia, immediately post-COVID, they were seeing rental rate collections upwards of 95% across their portfolio. So they were doing excellently. Most of the Class A landlords continue to do very well. So if you're living in a Class A apartment building, I would not recommend that you ask your landlord to defer your rent. If you're living in a Class C apartment building, you are more likely to see more of your peers requesting rent relief as people have lost their jobs and as people, have less disposable income as a result. So you might have a little bit more leverage if you're in a Class C apartment building. However, what we have seen, over the last couple of months is requests for rent relief have gone down significantly, which is positive because this is like a landlord's worst nightmare where they have to go and individually renegotiate or tell people no over and over and over again. Requests for rent relief in the office market, we had seen on average about 3 months requested. I'll tell you, when most landlords requested financials, they were not able to justify the rent relief requests that they were seeing. So a lot of people did not receive them. So if you're an office tenant, I would say most people are still paying their rent. Your best shot is if you can demonstrate, drastically poor financial performance, or if you've got a short-term lease that you can get out of soon. So just to be clear, most people continue to pay. And that, I guess, was the end of my actual slides. I am happy to talk a little bit more about retail just for a second. I think that might be a point that we missed. We saw about 25% rent collections across our portfolio during the pandemic as compared to 85 or 95% in the office market. So we can certainly understand, why that's been a bigger challenge. And I think one of the things that we're going to see on the retail side is an ongoing shift, even for smaller retails, into omnichannel. In a lot of ways, the pandemic has really sped up a lot of the structural change that was occurring in the retail market as a function of e-commerce encroachment and expansion. So in many ways, this might be some of the creative destruction that was already going on with retail. But, I do know our restaurateurs in our great restaurant city are suffering desperately. And I'm not sure until we can get back to indoor dining what that looks like for them, especially considering that it's real cold in Philly beginning in October. So I'm like, dining outdoors with friends. I feel good about that, but I'm not sure where we go in October, November, December. So that's why I kind of hold this hope for a vaccine. So at this stage, I'm going to probably just stop sharing my screen so we can all kind of see each other. But I'd be happy to take questions and comments from everybody. And I see a couple coming in, but I might need a little clarification, kind of as we get to some of them. So if anybody who had a question so far wants to unmute, I'd be happy to take your question.
Carol, do you want to ask your question about the cities?
Yeah, my question is more generally around the future of cities. And, I've actually started to return to work a couple days a week. And when I drive through Center City, and I see the level of activity and I think about the future, even post-COVID and vaccine and things of that nature, and thinking about what, becomes a new normal for a return to work for most people. Like, I can't imagine that it's going to go back to, the level that it used to be. And so what are your thoughts regarding, urban environments versus suburban environments versus the work from home, and, just in more generally?
Yeah, it's a really big question. And I think there's a lot of ways to start to think about it. I mean, in this market cycle, one of the so first of all, Philadelphia is very different than most other cities. Although we feel we've seen a renaissance in Philly, have not experienced the same level of activity and growth that most other cities did. And I think there's a whole host of reasons for that. But I do think that we were starting to kind of catch up in terms of our ability, especially to attract and retain talent. So we saw over 55% of all of our regional college students staying here. We saw a net importation of workers from New York. And when I would talk to companies about, coming to Philadelphia, the argument that I would make is, listen, your talent, which has grown, your high educated workforce has grown 55% since the last market cycle. The talent's here. The talent doesn't want to reverse commute to the suburbs. The talent has moved downtown, to be able to access the lifestyle and amenities. You will do better competitively if you can stay close to the talent. So that's been, I think, the driving force behind cities' renaissance during this market cycle. There was a data point that came out of Massachusetts that looked at income stratification and the percentage of people that had been laid off. And this was earlier in the pandemic, so I would probably need to get an update for this. But basically, on the low income spectrum, 70% of people who were making, call it, less than $35,000 a year had been laid off. If you were making $75,000 or more, the percentage of people that have been laid off was about 1%. So the knowledge worker is largely doing what we're doing. And, certainly have heard stories, of people losing their jobs and companies right-sizing, but we haven't seen mass layoffs, sort of in the professional office segment of the economy. So one of the challenges is going to be, how do we kind of correct for what's happened? We're definitely going to see people move out. We've definitely started to see that, whether that's individuals, kind of that talent, or the workforce, and how will Philadelphia approach, bringing them back? And I think a lot of it starts with the quality of life issues that we still hadn't addressed in the last cycle, whether that was trash, or homelessness, or public transportation, and I think focusing on those very basics, is going to be critical. Cities always rebound from this stuff. Every major health crisis that's ever happened around the world in the history of humanity, even though people left the city, people came back to the city. So I don't see why this will be that different, especially considering that we're 4.5 months into the pandemic. It feels like 4.5 years, and I'm as over it as everybody else. But in the course of my lifetime, this is a blip on the radar so far. Even if it is 18 months, it'll still be a blip on the radar. So the question is, how can we look forward and prepare ourselves from an infrastructure perspective to be able to re-attract companies and talent? So I don't think the city is dead. I do think we'll see a correction. Jane Jacobs talks in Death and Life of Great American Cities about this natural cycle of neighborhoods kind of unslumming and slumming and unslumming and slumming. And what happens in this moment is that the cost of real estate falls, and creative new solutions, creative new entrepreneurs, creative new businesses can all of a sudden afford to start, stay, and grow. And I think that we're going to see that because the advantages of agglomeration in cities for economic output can't be underestimated.
Okay, we had a question on your thoughts on how the election would affect all of this if Trump wins, if Biden wins.
Is this my buddy Chris Rosenbluth? Are you asking me this publicly, Chris? I thought I'd seen your name on there. Look, I'll be candid, speaking as myself personally, not as a representative of JLL for a moment here, which I don't know, maybe I'll still get in trouble. Not that anybody's told me one way or the other. I think the biggest problem that we've experienced during the pandemic is the erraticness coming out of the White House, is the lack of clear leadership coming out of the White House, is the lack of direction, is the lack of bringing America together, that's produced the need for protest activity, which probably existed previously, is what's caused people to be so frustrated that they're destroying buildings, right? And so when I look at, a scenario in which Trump is possibly reelected, I see a lot of that continuing. And I think it's really negative for the market. Markets don't like uncertainty. The election is uncertainty, yes, but I feel like we've been existing under a federal system that has by design created uncertainty, by necessity of its own survival created uncertainty. And so when I look at what's going on, maybe you have not, amazing feelings about Biden, like he's old and, he's been around for a while and he's a Washington insider, but he feels from a market perspective like a much more steady hand that perhaps will behave a little bit more rationally once elected. So that's kind of how I fall on that issue. And I think the market, the real estate market, the stock market, the economy overall will respond very positively to a more even-keeled leader.
Okay, how is the market trending with respect to adaptive reuse versus developing new construction? What about mixed-use projects and the flexibility and potential for stay-at-home within a single development?
I think when we look at adaptive reuse, and I think there's a lot of parts to this question, so Ben, I might have to ask you for part two. But adaptive reuse versus new construction, I'll start there. I think that there is a perception that new construction will be healthier for the office occupier or for the apartment occupier. So we've seen a lot of, I'll call it real estate performance theater around retrofitting HVAC systems, for example, to filter microbes or, to have, better air pressure for, increasing circulation. And I'm, again, not a scientist, but it does feel somewhat performative to me. That being said, it is what the consumer is demanding and what makes the consumer feel more comfortable. So I do think that when you're doing new construction and you can kind of, for example, have standards for buildings, whether they be LEED or the Fitwell standard or whatever the case might be, that's really attractive to people that have been really sad and scared about their health for a long time. So that's kind of one leg up that new construction has. New construction also, in Philadelphia, we've needed it for a long time. We still have had, very old apartment buildings, very old office buildings, and we haven't seen, even though we've seen some, we haven't seen a ton of new construction. And as much as it feels like it, we've added maybe about 15,000 units to Center City for a population that's grown 35% since 2000. That's not a lot. At the same time, kind of converting, offices to those apartment buildings. So I really feel that we need a new construction just to begin with, and it'll make people feel better. And then what was part two, Ben?
What about mixed use projects and the flexibility and potential for stay at home within a single development?
So one of the things that I've been doing a lot of work on recently is with a concept in our company called JLL Flex, which is like co-working, but a little bit different, more private offices. So if your standard WeWork would be, you know, maybe call it 30% private offices and 70% kind of open area, JLL Flex believes that the future is going to be more in those small private offices with shared amenities doing short-term leases than it is going to be in that open co-working. So we have, or I have with clients on a couple of occasions looked at citing this type of operation within an apartment building setting. And I think what's interesting is that in that type of mixed use development, you know, it provides you with a second space within a building, like even if you're scared about public transportation, right? To be able to go work and not feel like you're, you know, doing what I'm doing, which is sitting on my couch in my living room at this point in time. It's actually starting to like hurt my body, right? So if I could, you know, as an individual have a small private office for, you know, a couple $100s a month, and kind of still be socially distant, but, you know, able to see people, and see like that life is happening and business is happening, I think it would be very positive. And there's actually an article in BizNow today, if you guys receive BizNow, that was talking a lot about the demand for flexible office and private office within flexible office. So I think it's a home run in apartment buildings.
Ernest, maybe tell me if this is still where we're going. Both sides of the opinion on the office size of the future. Not sure if you were just getting to this. Are we looking at companies decreasing office size, maintain current ratios, or increasing office space?
So one of the slides I didn't include in today's deck was looking at the next 3 years and the impact to office demand as a result of what's going on in the world. And JLL's house view is that, you know, the work from home shift or percentage of, you know, shifting work to home will probably decrease office demand by about 10% over the next 3 years. However, that demand kind of decline will be offset by two things. One, de-densification in current offices. So JLL Philadelphia, we are at about 115 square feet per person. You know, if you're in a co-working space, it's about 55 to 75 square feet per person. It's really small. So de-densification to enable some level of social distancing or some level of comfort around sort of health over the next, call it, you know, 3 years, 3.5 years, we anticipate that that de-densification will cause about a 6% increase in office demand, coupled with natural job growth, which we think will increase demand by about 4%. So I think what we're gonna see, and this maybe is going back to even Carol's question, is, you know, for large corporate occupiers, a decentralization so that there's some redundancy and duplicativeness in the portfolio. So rather than have, you know, call it 100,000 square feet in a downtown office building, maybe we see a downsizing by 25,000 square feet, and that 25,000 square feet becomes little office pods, either in flexible environments or in small leases all over the region, so that people don't need to get on public transportation and come into a dense environment, so that people can drive and park, so that people can work closer to where they live. So I think that those are our initial kind of feedback on those numbers, but I don't see people, you know, at this stage, considering that, again, we're 4.5 months in and leases are kind of 5 to 10 years typically. I don't see like a wholesale kind of drop off in size requirements just yet. I think we need a little bit more data, but that's generally our house view.
Marty, does that kind of answer your question, or do you want to still ask your question?
Okay, I think I unmuted. So we're already seeing, of course, many stores shut down. We're seeing, I'm questioning what the next level of absorption is going to be, whether that's on the hotel side, whether that's on the anticipation of retail, malls. You know, what do we imagine in our market in terms of shutdown or closing, businesses closing, and how do we expect that space to be absorbed?
Marty, I'm not 100% sure. You know, on the retail side specifically, you know, I think we're going to see some workouts with landlords. So, you know, retail space is always going to be retail space for the most part, especially in business districts. So like when I think about Walnut Street, you know, that space doesn't really have any kind of reusable value as office or living space. So in most cases, it's to the landlord's advantage to rework those deals, I think, to have, you know, more of a percentage rent component as opposed to a base rent component. Because I think that, you know, they're not going to re-tenant the space, right? There's not a ton of landlords kind of out, or rather tenants out there looking for new retail space. So we have seen new stuff. I mean, I was shocked to see the Allbirds opening, which is amazing in Center City. And I think that they would be foolish to kind of like shoot themselves in the foot, you know, for no cash flow as we kind of wait for the situation to arise. So I think we need to, especially if you're working with retailers, you know, kind of function more in lockstep with the business overall. On hotel, I think that I worry a little bit about just the density of hotel rooms. So for example, you know, elevators have emerged as like a cause of contention with regard to reopening, how many people can be in them, you know, is there enough capacity to serve a large office building? Same thing with a large hotel building. You know, I think what was interesting about sort of the consumer cash infusion is I think that obviously some people spent it, right? But some people just saved it, right? And I think that a lot of consumer decisions are being driven by fear. And, you know, that negative RevPAR, I think, tells you what you need to know when it comes to what's going on with hotel. I mean, Philly is kind of ass backwards too, because we are typically more driven by tourism as opposed to business travel. And business travel is even less likely to resume, but, you know, tourism is not kind of popping back either. So I don't know. I think the outlook is really uncertain. And I would be worried about, you know, buildings or hotel projects that are highly leveraged right now.
That's all we have for questions in the chat. If anybody has anything else, any other questions?
If I may ask another one, Marty Tussman again here. Wondering what we anticipate the long-term effect of all this cash outlaid by the federal for all these stimulus plans. What do we see the impact of that over the years to come? Is that just all debt that remains? Is that taxes that must increase? How do we see that being managed?
So Marty, I was like doing a little bit of research into this. And again, I'm not, you know, a macro economist, but, you know, most of that debt is held by US consumers. So when you look at kind of who's holding the majority of the national debt in the United States, it's individuals, it's, you know, people's retirement portfolios, et cetera. So if everybody decided, you know, to cash in, you know, on their bonds right now, we'd be in a heck of a pickle. So I think it could have, you know, an impact on bond returns over the long term. The other thing that I see too is the fact that, you know, a significant percentage of that debt's owned by foreign governments. So that also poses a security risk, you know, to the United States overall. If, for example, you know, we kind of get into a tiff with, you know, a country that, you know, we're highly leveraged with as a result of them buying US debt. So when I look at the market, like that also concerns me too, because I think we've done, you know, quite a number on angering some of our, you know, strongest economic partners over the course of the pandemic. I don't think that it's politically feasible for anybody to come in and say, we're going to raise taxes to pay off the national debt. Like most US consumers don't care. However, I'm not really sure where or how we ever, you know, kind of get out of debt or more to a more reasonable level. And I think, you know, that kind of benchmark of 250%, you know, debt to GDP ratio, considering we're about halfway there, you know, we're not in great shape, but, you know, we're not in dire straits yet. So I don't think that just yet it's a massive concern.
Anyone else want to unmute and ask a question? There's no dessert, so we're not waiting for that.
I was waiting for the chocolate cake, Ben, to arrive at my door.
There was a new submission in the chat box, Ben, I think.
Okay.
Graham, Graham, is that a question?
You can comment too. I don't mind comments.
Well, yes, we're talking about vacant storefronts.
Oh, Graham, can you speak up?
Vacant storefronts. Can you hear me now?
Yep.
And, I think a lot of zoning codes preclude more office type uses at the storefront level in some places. And given the potential for a lot more vacancy, I think that uses that are quasi-retail but more professional services like a commercial or a residential real estate firm, that relies on visibility and walk-in, might be good alternative uses for some of these spaces. Where in the past there hasn't been that flexibility in some places that don't allow those more professional office uses on the first floor. I think there may be a need now to accommodate to just help with filling vacant space.
Well, I think you're also raising an interesting point around activation. Really safety in cities in particular depends upon eyes on the street and the perception that other people are paying attention. So like a boarded up storefront or a vacant storefront inherently feels way less safe than a storefront that's, simply got people working in it at desks. Right? I mean, obviously it's not as great as like a coffee shop or,
Right.
An apparel retailer, but it inherently provides some type of value to the street level experience. And I think landlords are going to have to get creative and kind of move off of some of their preconceived notions of their rent pro formas for retail spaces in order to kind of help the overall climate of the downtown and the street life.
Right. Value not only for the pedestrian experience, but value to the property owner who needs to pay mortgage.
Yep. Agreed.
I'm going to take liberty and jump in for one more question, Lauren, because I think you're so brilliant and I love listening to you always. So there you go. I'm gonna lobby a hard one, maybe. We're at the intersection of COVID, but we're also at the intersection of all the issues of Black Lives Matter, about how we look at economic disadvantage and all the multitude of disadvantages in our Black population, being a city with as much poverty as we have, with as large as a Black population. I don't know where I'm going with this question other than to ask you, what does the intersection of our economy and region look like with some of these issues and kind of the consistent chronic disadvantage of Black population over the years?
It's a great question, Marty, and I don't know that anybody has, the silver bullet answer, but, I was getting asked probably a year prior to the pandemic as we realized the economic cycle was, lingering for an extended period of time and boom times, what I thought the biggest risk to the economy was. And my answer then, as my answer, still stands right now, is widespread inequality. I don't mean to be like glib about it, but, we've seen inequality produce revolution in, every major civil society period in the course of human existence. Like I think about the French Revolution, and how they overthrew, a monarchy because we had people that couldn't eat. And so when I think about what we've created as a result of lack of investment in education, as a result of, racial profiling of Black men in this country, as a result of, the cultural disconnect that has produced, white culture being the dominant culture in the United States, that the center of societal structure cannot hold, when you've got people making, billions of dollars, like a Jeff Bezos, right? And then you've got people that see it, right? That see it on social media, that see it on television, that are like, why in the world, like, am I scraping by, working, 40 hours a week to make $30,000 a year, which is reality in Philadelphia, right? So until we can address access to economic opportunity, right, and the structures that have prevented particularly Black individuals, but, many other groups as well, immigrants, from accessing economic opportunity, we're going to have continued ongoing social unrest. And when I look at kind of Black Lives Matter this summer, yes, people were stuck at home. yes, we saw several, Black individuals be killed in cold blood, by police. However, this wasn't like, this was just an overnight thing. Like, it was just like the spark on a powder keg of, the diverging access to resources that we have managed to put into the structure of our society. Again, I don't know exactly what the precise answer to all of this is, because I think it is a really hairy systems problem, but on some level, I'm not surprised. And I think that that's the challenge that we need to think through is, like in Philadelphia, how can we grow the top line revenue of the city? How can we grow the top line economic numbers, but also make sure, that the opportunities filter to everybody? And I don't think that that's handouts. I think that that's education. I think that that's training. I think we've wildly underinvested in a lot of our populations in the city.
Agreed. Thank you.
Hey, Lauren, it's Chris. Since
Hi.
you called me out, I'll jump in and ask you another question. Have you all started to think about how or what form distressed real estate buys will take in this market? For example, we've seen Simon Property Group, I think, has already bought 2 major retailers, which I assume is more of a real estate buy than the desire to get into retail sales. I'm just wondering if you all had started to look at that, given that, a lot of the market downturn here is based really on uncertainty rather than, the last market downturn, which was more about the capital stack than anything else.
Chris, we started to have some of those conversations, but candidly, the level of distress in our region is really low so far. I think I got a call from a reporter, it's probably 6 weeks ago, and it was like, there's $2 billion of distressed real estate in Philadelphia, and most of it was on the retail side of things. And, that's not surprising, right? But $2 billion, I mean, Comcast, 2 is, a $1.5 billion project, right? So we're talking about, call it 1.5 Comcast 2s across the entire region that have become distressed. So far, there's not a lot of it. I think the fall is really going to be telling when it comes to, where distress starts to pop up. I mean, I think what we learned in the 08-09 cycle was that we needed to be a lot more conservative kind of in the underwriting. So I think people did a better job, kind of overall. But I also wonder, to your point about Simon, like heading into this downturn, there were massive, massive quantities of dry powder available to invest in real estate. And I'll tell you, talking to investors, I had a number of clients tell me, we're just waiting for the market to turn. Like, we're like ready to go on the sidelines as soon as there are deals that actually make sense. Like, we're totally like willing to let, these yokels like overpay at the peak of the cycle, and we're just sitting and waiting, right? So I think we're going to see, a lot more in the fall. And I think that there's, going to be some capital out there to buy those assets. But I right now see it predominantly only in the retail sector.
Well, it looks like we're actually just about out of time, unless anybody has one last question.
I was actually going to follow up on the question that I think Marty had asked. The city's got obviously a pretty strong budget issue right now. And there, things are going to be impacted by that, the tax abatement being one of them, which was already being talked about before this happened. But given the problems with the quality that you were talking about earlier, what do you see the budget impacts at the city level having on development in Philly?
I think that the city of Philadelphia has really shot itself in the foot with the complexity of of the tax structure, number one, and the reliance on business taxes. I've said this time and again, but if I had a magic wand that I could wave to correct any problem in Philadelphia, it would be to have a broad-based real estate tax Maybe commercial versus, residential, different rates if Harrisburg can let us do so. But the fact that, we've always taxed things that can move, right, what has hampered our growth, number one. And number two, we have seen, companies not be able to pay the BIRT, the business income and receipts tax. I would, if I were advising a tenant client, say, you need to go to the city and debate your use and occupancy tax since your, office space is unoccupied. And now we're also seeing people who lived in the suburbs working in the city debate and or apply for exemptions to the wage tax, of which they're paying 3.5% of their gross wages to the city of Philadelphia. In its infinite wisdom, to try to close the budget gap, we've also now, raised that non-resident wage tax for people to work in the city of Philadelphia. And I understand the goal, is to raise those revenues, but, we also have a bit of a spending problem where over the course of this administration, the spending in the budget has increased by over $1 billion in the course of 4 years. So we're raising taxes, we're spending more, we're not spending smartly. When City of Philadelphia kids are told to sit in their cars to catch the school Wi-Fi to be able to learn, we are setting up another generation of largely Black individuals to lives in poverty that require government assistance. And so there's just like no logic, in my opinion, and there's no vision to the way in which we're taxing and the way in which we're spending. And we can address, minority representation with employment, equal opportunity employment plans, for government projects all we want, but until we address the root causes and the systemic causes, we're going to get ourselves nowhere. And now we're chasing out some of the highest earners and some of the biggest contributors to the wage tax in the city of Philadelphia, i.e. those suburbanites that come into the city to work. So I'm deeply concerned. I mean, the budget gap is a problem, but like the way that we're trying to resolve it is even scarier.
Thank you.
Mm-hmm.
Any last questions?
Yeah, this is Kevin McHenry. Just a question about your opinions on academic neighborhoods. I'm thinking about University City and Temple, where the risk may be that online classes will keep kids from showing up, and all of a sudden the demand will drop for real estate, or maybe the opposite. Everyone's going into singles, and now there aren't enough places. What are you guys thinking at JLL?
So I was fortunate to have received the plan for Penn to reopen. And what's really interesting about its plan is that basically, obviously they're going to end at, Thanksgiving time. People aren't going back. There's going to be no fall break. There's going to be some in person, some online, cafeterias, takeout only, this, that, the other. But when it comes to the housing situation, right, like University City was already quite crunched for housing, which spurred a couple of the high-rise developments that we've seen over the last few years. And going to those single rooms, right, and then having to accommodate a graduate school population, I think is only going to increase demand for housing, and the university is going to be paying for some of it. So on that sense, yes, retail, food retail, especially if they can accommodate takeout. I mean, like if you're 20 years old, like how often do you want to eat at the cafeteria, right? Especially if it's kind of like bagged lunch style. So I think that we'll see, kids continue to spend. But the question that I have overall is whether parents are going to be willing to shoulder the bill of a Penn education, that the experience of it is a fraction of what it once was. Obviously there's the education, but, a big piece of college life is the social experience, not, just partying, but literally learning how to be an adult. Right. And they're not going to get that, I think, to the extent that they would anticipate. So I do wonder what enrollment is going to look like. I think, a place like Penn is highly valuable in terms of the overall degree, Ivy League, absolutely. But I just saw an article recently that was looking at kind of a matrix of like what institutions were in trouble versus what institutions sort of provided a large enough value proposition to persist. And, over the course of the last decade, we've seen a perpetuation of these for-profit colleges, these online colleges, because in the US we have this kind of like, strong bend towards receiving a college education. And I do think that we're going to see a shift in that. But I think, look, if we get a vaccine, I mean, maybe the semester, like maybe it's just a matter of weathering the semester, right? Or weathering the year. And certainly colleges that have big endowments are in the best positions to do so.
Bissy, did you have a question?
Yeah, thank you.
Hi.
Hi. I was wondering if there are any like historical lessons learned from the 1918 flu and, city recovery after that you're kind of applying to your analysis now, or is it just too different a set of circumstances?
I know a lot of people are reading books about the 1918 flu, and maybe this is like my next pandemic project is to read one, because I haven't been thinking too carefully about it. I think that what economically, we're going through is very different than what we experienced in 1918 because of, what we're able to do here, be on a Zoom call. I think, what is different is in 1918, I feel like the collective mentality was a little bit stronger, and people were, more inclined, to kind of fall in line with what the health requirements said. And because we have become so individualistic as a society, I think that people are less likely to kind of do as they're told. I mean, certainly our leadership kind of being fractured in terms of what the messaging is not helping. Like I saw a newscaster from like, what's the famous newscaster? His name is like escaping me, in Philadelphia, doing a commercial for wear a mask, literally like in the middle of like a different TV show entirely. And I was like surprised that we are using sort of our famous figures, to kind of spread the messaging around health and safety, because the federal government in particular is so fractured. So I don't know that there's a clear lesson that I would draw at this point in time. I think that the world is so different at this moment, but maybe I need to spend a little time with one of those histories.
Thank you, Lauren.
Thanks.
So I just want to thank you, Lauren, for taking the time to do this for us. It's been a great conversation. Also, during this difficult time, the whole organization really appreciates members who have continued their membership. So of course, if you're not a member, we'd love to have you join. You can do that on the website. Also check for upcoming events for the next one. And just wanted to thank everybody again for their time today. I'm glad we can do it on Zoom. Otherwise, we'd be home and not communicating with anybody at all. So at least we've got that going.
Thank you so much for having me, everyone. It was a real pleasure to be with you.
Thank you, Lauren.
Great. Thanks very much, everybody.
Yeah.
We'll see you at the next event.
Thanks, Lauren.
Thank you. Great job. Thank you.
Thank you. Take care now.